guys, welcome to lesson 2. We're going to break down the mortgage payment. We did cover a little bit about DTI, debt to income ratio, and talking about how much they can afford. But talk to me a little bit about how principal and interest plays a factor in your mortgage payment.
So, the mortgage payment consists of basically there's 4 pieces to the mortgage payment, but when as a lender, we are considering how much you can afford. We're considering 5 things. It's principal and interest, it's your taxes, homeowners insurance, mortgage insurance, which is not applicable in all cases. We talk about that, and also your homeowners association or condo. So all of those things make up your housing obligation instead of the mortgage payment. The mortgage payment is principal and interest, taxes, homeowners insurance, and mortgage insurance, if applicable. And then generally you have a homeowners association fee or a condo fee if you live in a planned unit development or a condo. All right. So you asked first about principal and interest. Principal and interest is exactly what it's the principal plus the interest. That is the part of the mortgage where you're paying the lender back, and you're paying the lender the interest for using the money.
Right.
All right. So the principal and interest is a fixed number, generally speaking, if you have a fixed interest rate. All right. If you get a fixed interest rate, your principal and interest payment will never change. It's going to be the same for the whole 10, 15, 20, 25, or 30-year term of the mortgage. In most cases, most first-time buyers and most buyers throughout the country are doing 30-year fixed-year mortgages. So that's the gold standard for mortgages, a 30-year fixed-rate mortgage. Your principal and interest will stay the same. Now, what happens is just in that principal and interest, because as you pay, every payment that you make is paying principal. Since the payments is the same throughout the whole term, you're paying principal and interest. At the beginning of the term, you're paying a lot more interest than you are principal. And it takes a while for that to flip to where you ultimately are paying more principal than interest. So there are some strategies that folks can use to shorten the term by paying a little bit extra per month to pay their house off more quickly, by maybe making 2 payments per month as opposed to 1, which actually ends up being an extra payment per year, because there's 26 bi-weekly periods in a year, which if you're paying, that's 13 bi-weekly payments that you're making, or 26 bi-weekly payments that you're making instead of 12, one per month, which is 12. Or you can also just round up your payment. Sometimes your principal and interest or your mortgage payment is $1,563, and just send a check for $1,600. That extra $30 adds up and might knock off 1 or 2 years off your mortgage payment. All right.
That's pretty good. I wouldn't even think about it that way.
Right.
An extra $30 could knock some years off your mortgage payment, but mortgage insurance.
Right.
I know that there's a difference between mortgage insurance and homeowners insurance. But
Right.
mortgage insurance is actually calculated into the payment. Am I correct?
Right. So before we get to mortgage insurance, I want to talk, because that one's a little bit trickier, and we're going to have a whole separate segment on that. But the next piece is taxes, principal and interest, taxes, property taxes. So property taxes are based upon the jurisdiction that you live in. Whether it's a city or county, there is an annual tax bill that comes out, and you have to pay that. It's assessed. It is each jurisdiction has a tax rate, and your property is assessed either annually or maybe on a 2 or 3 year cycle. Maryland's 3-year cycles typically when the assessments are made, and a tax rate is applied to that, and that is your tax bill. And that tax bill is included in your mortgage payment because it's an obligation. Mortgage companies in general, unless you put 20% down, are going to want to make sure that the taxes are included in your mortgage payment because we need to make sure that's paid. Because if your taxes don't get paid, you can actually lose the property. So now, I wanted to differentiate the taxes from principal and interest because unlike the principal and interest payment, which will never change on a fixed rate, your taxes can change over time. It can go up or down. Usually going to go up. Hopefully they're going to go up because if your taxes went up, that means generally either the jurisdiction raised your tax rate, which doesn't happen that often. Most likely what's happened is that your property value increased. All right, so it's good news. Bad news is your payment goes up a little bit because your tax bill went up. But good news is that it went up because you're worth more money now because your property is worth more money.
Yeah.
So the taxes is a third component there, and then then you get into the insurance. All right. So there are 3 types of insurance, and we'll talk about this in a separate segment. The 3 types of insurance that you're going to encounter with a mortgage. Mortgage insurance, homeowners insurance, and then also title insurance. All right. I'll take title insurance really quickly. It's not a part of your payment. It is a closing cost that you will that you'll pay one time as part of the transaction. We'll get into that detail in another class where we talk about the fees that are associated with the loan process. But homeowners insurance and mortgage insurance are included in your mortgage payment. All right. Homeowners insurance is the insurance that you pay to make sure that if something happens to your property, it gets rebuilt or the damage is repaired. Mm-hmm. Mortgage insurance is protects the lender. It does not protect you as the homeowner. Mortgage insurance is, and we'll get into that in detail in a separate segment. We'll go deeper into it. So, but you got homeowners insurance. Generally speaking, homeowners insurance is going to be anywhere from $600 for a property in the $100,000 range to maybe it could be $2,000 for a property in the $700,000 or $800,000 range. But you know that the homeowners insurance payment is going to be roughly $50 to $150, generally speaking, of your mortgage payment, depending upon the homeowners insurance premium. The mortgage insurance is not always required. Mortgage insurance comes into play when you have less than 20% equity in the property. You make less than a 20% down payment. We're going to get into that in a little bit more detail in a separate discussion. But the mortgage insurance is, again, something that protects the lender. Like I said, we'll discuss that in a little bit more detail.
Gotcha. And I think that it was interesting that you said it was about 104. So I'm assuming that in a property maybe about 300,000, right? Mm-hmm. You may be looking at 900 for just principal and interest, but when you add on that property tax, it kind of hikes it up. Mm-hmm. Now you add another $300 to $400 on your payment, right? Then that extra 100. Now you're looking at a $1,600 payment. Right. Makes sense. Right. That makes sense. Well, right. I appreciate that. That's
one of the reasons why sometimes folks say, hey, well, I mean, that payment's like a little bit higher than what I wanted. What if I put an extra $10,000 down? Yeah. All right. People, that doesn't change your payment that much, generally speaking, because you know, just making more money as a down payment, you know, with interest rates where they are, I always tell folks every $1,000 that you put down in excess of the minimum is generally only going to maybe save you about $5 per month. So if you put $10,000 down more, it's going to be maybe $50 a month. Generally speaking, I think people are better off with that. If you've got an extra 10, right, you're better off keeping that 10 in the bank than putting that money down.
Right. Yeah. No, makes sense.